Did you know that every single day, trillions of dollars are exchanged in the global financial markets? But what if I told you that behind this colossal figure lies a world that's both fascinating and complex, a world of financial derivatives? Welcome, viewers, to Satoshi Finance, where we navigate the complexities of the financial world to empower you on your journey to financial freedom. Today, we will take you on a journey into the intriguing realm of financial derivatives, where risk meets opportunity and where fortunes are made and lost in the blink of an eye. Picture this. In 2020, the global derivatives market was valued at a staggering $640 trillion, dwarfing the world's GDP several times over. But what exactly are derivatives, and how do they wield such immense power within the financial landscape? Join me as we peel back the layers of this financial enigma, exploring the realms of futures and options, where contracts are made on everything from precious metals to stock indices, and where savvy investors hedge against risk and ambitious traders seek out profit. Financial derivatives serve as the intricate instruments underpinning modern financial markets, embodying a multifaceted role that extends beyond mere transactions. At their essence, financial derivatives are contracts whose values derive from the performance of underlying assets, be it stocks, commodities, currencies, or interest rates. These contracts play a pivotal role in mitigating risk for various market participants, offering a shield against adverse price movements and fluctuations. Whether it's a farmer safeguarding against future crop price declines, or a multinational corporation hedging its exposure to foreign exchange fluctuations, derivatives provide a versatile toolkit for managing risk in an uncertain economic landscape. Moreover, derivatives serve as catalysts for speculation, attracting traders keen on capitalizing on price movements for profit. Through leveraging their understanding of market dynamics and employing sophisticated trading strategies, speculators navigate the volatile terrain of derivatives markets, seeking lucrative opportunities amidst the flux of supply and demand. In the realm of financial markets, the importance of derivatives in both risk management and speculation cannot be overstated. Beyond their function as risk mitigation tools, derivatives facilitate liquidity and price discovery, enhancing market efficiency and fostering economic growth. By enabling investors to hedge against unforeseen events and facilitating the transfer of risk from those averse to it to those willing to bear it, derivatives contribute to overall market stability. Simultaneously, the speculative nature of derivatives injects vitality into financial markets, driving innovation and providing avenues for investors to express their views on future market movements. However, this duality of purpose also underscores the inherent complexity and potential pitfalls associated with derivatives trading. As markets oscillate between periods of euphoria and turmoil, understanding the nuanced interplay between risk management and speculation becomes paramount for market participants navigating the intricate web of financial derivatives. Futures contracts stand as pillars within the realm of financial derivatives, embodying a contractual agreement between two parties to buy or sell an underlying asset at a predetermined price on a specified future date. These contracts offer investors a means to hedge against future price fluctuations or speculate on price movements, leveraging the inherent volatility of financial markets. At their core, futures contracts function as standardized agreements, facilitating liquidity and ease of trading on organized exchanges. Unlike forward contracts, futures are standardized in terms of contract size, expiration date, and settlement method, providing transparency and reducing counterparty risk. The key components of a futures contract include the underlying asset, which can range from commodities like crude oil and gold to financial instruments such as stock indices and interest rates. Additionally, futures contracts feature an expiration date, signaling the maturity of the contract, after which the parties are obligated to fulfill their contractual obligations. Moreover, futures contracts specify the contract size, dictating the quantity of the underlying asset being traded, and the settlement method, which determines how the contract is settled upon expiration, whether through physical delivery of the underlying asset or cash settlement. Examples of futures contracts abound across various markets, with commodities, futures such as oil futures and agricultural futures dominating the commodities market, while stock index futures like the S&P 500 futures and NASDAQ futures reign supreme in the realm of financial derivatives. If you've made it this far, consider taking a moment to subscribe to our channel. Subscribing is absolutely free, and you can always change your mind. We have a wealth of financial insights and exciting discussions lined up for you. Your support not only helps us reach a broader audience, but also motivates us to continue creating high-quality content that educates and empowers viewers like you. So, hit that subscribe button, stay tuned, and join us on this journey towards financial empowerment. Thank you for being a part of our community. Options contracts represent a dynamic facet of the financial derivatives landscape, offering investors the right, but not the obligation, to buy call option or sell put option, an underlying asset at a predetermined price, strike price, within a specified period, expiration date. Unlike futures contracts, which entail an obligation to buy or sell, options provide flexibility, allowing holders to exercise their rights at their discretion. These contracts are characterized by their versatility, serving as both risk management tools and instruments for speculative trading. Option contracts are structured around several key components. The option premium, which represents the price paid by the buyer to acquire the option. The strike price, determining the price at which the underlying asset can be bought or sold. The expiration date, signaling the deadline for exercising the option. And the exercise style, which dictates when the option can be exercised. Either European style, only at expiration, or American style, anytime before expiration. A fundamental distinction in options contracts lies in their classification as either call options or put options, each offering unique opportunities for investors. Call options grant the holder the right to buy the underlying asset at the strike price, making them advantageous in bullish market conditions, where asset prices are expected to rise. Conversely, put options afford the holder the right to sell the underlying asset at the strike price, proving beneficial in bearish market scenarios where asset prices are anticipated to decline. The interplay between these two types of options, along with their associated premiums, strike prices, and expiration dates, forms the basis of sophisticated trading strategies aimed at capitalizing on market movements and volatility. Futures and options, while both integral to the world of financial derivatives, possess distinct characteristics that cater to different investment objectives and risk profiles. At their core, both futures and options derive their value from underlying assets, offering investors exposure to price movements without the need for direct ownership. However, a fundamental difference lies in the obligation associated with futures contracts, where buyers and sellers are bound to fulfill their contractual obligations upon expiration, compared to options contracts, which provide the holder with the right, but not the obligation to buy or sell the underlying asset. This key distinction underpins the risk-reward dynamics of these derivatives, with futures typically offering greater leverage, but also entailing higher levels of risk due to their obligation to transact. In terms of advantages, futures contracts provide investors with enhanced liquidity and transparency, thanks to their standardized nature and exchange-traded environment. Moreover, futures offer direct exposure to underlying assets, making them ideal for hedging purposes and capturing broad market trends. On the other hand, options afford investors flexibility and limited downside risk, as the maximum loss is confined to the premium paid for the option. However, this flexibility comes at a cost, as options premiums can erode over time due to factors such as time decay and changes in volatility. Deciding between futures and options often hinges on factors such as investment horizon, risk tolerance, and market outlook. For instance, futures might be preferable for short-term speculative trades, where leverage is desired, while options could be favored for longer-term strategies involving hedging or capital preservation. Ultimately, the choice between futures and options depends on the investor's specific objectives and the prevailing market conditions. Risk management lies at the heart of derivatives trading, with futures and options serving as powerful tools for hedging against adverse market movements. Hedging involves taking positions in derivatives contracts to offset potential losses from fluctuations in the value of underlying assets. Futures contracts, with their obligation to buy or sell at a predetermined price, are commonly used by producers, consumers, and investors alike to hedge against price volatility in commodities, currencies, and financial instruments. For example, an airline might use futures contracts to lock in fuel prices, shielding itself from the risk of rising oil prices impacting its operating costs. Similarly, options contracts offer businesses and investors the flexibility to protect against downside risk while preserving upside potential. A manufacturer, for instance, could purchase put options on a key raw material to guard against price increases, ensuring stable production costs regardless of market conditions. Real-world examples abound of companies leveraging derivatives to manage risk effectively in their operations. One notable case is that of agricultural businesses using futures contracts to hedge against crop price fluctuations caused by factors such as weather conditions and supply-demand dynamics. Similarly, multinational corporations routinely employ currency derivatives to mitigate foreign exchange risk stemming from fluctuations in exchange rates. By strategically incorporating derivatives into their risk management frameworks, companies can enhance their resilience to market uncertainties and safeguard their profitability. However, the efficacy of risk management through derivatives hinges on a nuanced understanding of the associated risks. While derivatives offer opportunities for risk mitigation, they also introduce complexities and potential pitfalls, including counterparty risk, market volatility, and liquidity concerns. Therefore, a comprehensive grasp of risk factors is essential for investors and businesses alike when engaging in derivatives trading, underscoring the importance of diligent research, prudent risk assessment, and ongoing risk monitoring. Speculation in derivatives markets entails the art of capitalizing on anticipated price movements, leveraging futures and options contracts to generate profits from market fluctuations. Traders engage in speculative activities to exploit perceived mispricings or capitalize on short-term trends, often employing sophisticated trading strategies to maximize returns. Futures and options provide traders with leverage, allowing them to amplify their exposure to market movements while requiring only a fraction of the total contract value as margin. For example, a trader might take a long position in a futures contract on a commodity if they anticipate its price will rise, aiming to sell the contract at a higher price in the future for a profit. Similarly, options traders might purchase call options on a stock if they expect its price to increase, thereby gaining the right to buy the stock at a predetermined price. A myriad of trading strategies exists within the realm of derivatives, catering to diverse market conditions and risk appetites. Long and short positions represent the most basic strategies, with traders betting on either upward, long, or downward short price movements in the underlying asset. More complex strategies include spreads, where traders simultaneously buy and sell options or futures contracts with different strike prices or expiration dates to profit from relative price movements, and straddles, which involve purchasing both call and put options on the same underlying asset to profit from significant price swings in either direction. However, speculative trading in derivatives is not without its risks. Leverage amplifies potential returns, but also magnifies losses, exposing traders to significant financial risks. Moreover, derivatives markets can be highly volatile, subject to sudden price fluctuations and liquidity constraints, further accentuating the importance of risk management and disciplined trading practices in speculative endeavors. The regulatory landscape surrounding derivatives trading is characterized by a complex web of oversight aimed at promoting market integrity, investor protection, and financial stability. Regulatory frameworks governing derivatives vary across jurisdictions but typically encompass a combination of legislative mandates, regulatory guidelines, and oversight mechanisms designed to mitigate systemic risks and safeguard market participants. In the United States, for instance, derivatives markets are subject to regulation by several key regulatory bodies, including the Commodity Futures Trading Commission, CFTC, and the Securities and Exchange Commission, SEC. These agencies oversee derivatives trading across different asset classes, ensuring compliance with regulations such as the Commodity Exchange Act and the Securities Act of 1933. Additionally, international organizations such as the International Organization of Securities Commissions, IOSCO, collaborate to establish global standards and best practices for derivatives regulation, fostering harmonization and consistency across international markets. Regulatory bodies play a pivotal role in overseeing derivative markets, exercising supervision and enforcement to uphold market integrity and investor confidence. These agencies implement rules and regulations governing derivatives trading, including registration requirements for market participants, reporting and disclosure obligations, and risk management standards. Moreover, regulatory oversight extends to monitoring market activities, detecting potential misconduct or market manipulation, and taking enforcement actions to address violations of regulatory standards. By fostering transparency, enforcing compliance, and maintaining orderly and efficient markets, regulatory bodies contribute to the stability and resilience of derivative markets, ensuring their role as vital components of the global financial system. Real-life case studies and examples offer valuable insights into the practical applications and implications of derivatives trading. One notable example is the 1995 collapse of Barings Bank, attributed to rogue trader Nick Leeson's unauthorized derivatives trading activities. Leeson's speculative bets on futures contracts tied to the Nikkei 225 index led to massive losses, ultimately resulting in the bank's bankruptcy. This case underscores the significant risks associated with derivatives trading, including the potential for substantial financial losses and operational failures. The Barings Bank collapse serves as a cautionary tale, highlighting the importance of robust risk management practices, internal controls, and oversight mechanisms to mitigate the inherent risks of derivatives trading. Conversely, the successful application of derivatives in risk management is exemplified by the case of Southwest Airlines. In the early 2000s, Southwest utilized fuel hedging strategies involving derivatives contracts to mitigate the impact of volatile oil prices on its operating costs. By locking in favorable fuel prices through futures and options contracts, Southwest was able to stabilize its expenses and gain a competitive advantage over rivals during periods of oil price volatility. This case illustrates the strategic use of derivatives for risk management purposes, enabling companies to hedge against adverse market movements and safeguard profitability. The Southwest Airlines example highlights the importance of prudent risk management and the potential benefits of derivatives in managing exposure to market uncertainties. In conclusion, our exploration into the world of financial derivatives has revealed the intricate dynamics and multifaceted roles these instruments play in global financial markets. From futures and options to sophisticated trading strategies, we've delved into the fundamentals of derivatives trading, uncovering their significance in risk management, speculation, and market efficiency. Throughout our journey, we've discussed the key components of derivatives contracts, the various strategies employed by traders, and the regulatory framework governing derivatives markets. Understanding financial derivatives is paramount for investors and traders alike, as they offer both opportunities for profit and avenues for risk mitigation. Whether you're a seasoned investor or a novice trader, grasping the complexities of derivatives trading is essential for navigating the ever-changing landscape of financial markets. While derivatives present opportunities for substantial returns, they also carry inherent risks, including leverage, volatility, and counterparty risk. Therefore, it is crucial to approach derivatives trading with caution, conducting thorough research, implementing robust risk management practices, and seeking continuous education to stay informed and adapt to market dynamics. I encourage you, the viewers, to continue your journey of learning about financial derivatives, exploring new strategies, and honing your skills as investors and traders. By staying informed, exercising prudence, and practicing disciplined trading, you can navigate the world of derivatives with confidence and capitalize on the myriad opportunities it presents. Remember, knowledge is power, and with the right mindset and approach, you can unlock the potential of financial derivatives to achieve your investment goals. If you found this video helpful, don't forget to give it a thumbs up. Subscribe to our channel for more insightful content, and hit that notification bell so you never miss an update. Thanks again for watching, and I'll catch you in the next video.